Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the Chapter 7 theory, which covers the cash and receivables. And we are on video number 6 here, which is going to cover the aging method. Okay, so the previous videos, I had talked about the direct write-off method, and then I had talked about the allowance method. We also covered a video on the journal entries that are made for both the direct write-off method versus the allowance method, what they look like. In the last video, especially the first part of the video, like maybe the first 7 minutes or so, I I went as an overview of what we're trying to do with our accounts receivable, why we're estimating, why we use the direct write-off versus the allowance method. And then also too, in the allowance method, we have in order to be able to figure out what our estimate is going to be, we're either going to use the percentage of sales method, which was covered in the rest of that video. And then this one here, we're going to do the aging method. So, go back, and if you didn't understand direct write-off, allowance, percentage of sales, go back and watch those videos. But if you had gotten it, but you're just not sure, go back and, as the entire process. I'm not going to repeat everything. Watch the first 7 minutes of video number 5 for the percentage of sales method, which covers an overview of what we're trying to do in the allowance method using the percentage of sales, or in this case here, the aging method. So with the aging method, I'm going to create T accounts here, my accounts receivable, and I'm going to just call this allowance, and I'm not going to write 4 uncollectible accounts or 4 doubtful accounts. You know that this is the allowance account, and here's my bad debt expense. Now, what we're doing with the aging method is we're looking at and this here is our accounts receivable subsidiary ledger. And what it does is it has a list of all of our customers, okay, and how much they owe, but it's an aging report. It's called an aging report. And the aging means that what's current, what is owed is past due for the between day 1 and 30, 31 to 60 days, 61 to 90, and so on and so forth. And how many, whatever period you decide to use is up to you. Quite honestly, this one here has 91 to 160, meaning anything after 3 months. Well, right here after 3 months all the way up to 6 months, and then this one is after 6 months. Okay, this is pretty standard, but you kind of you could decide for yourself. I mean, computer systems will print these out as a standard, so that's why you're looking at it. But anyway, so you have a list of the customers, you have the balances. Notice that the total balance is $32,000. So in my accounts receivable general ledger account, I should have a balance of $32,000, right, to match that. Now, at the end of the accounting period, and again, go back and watch the first 7 minutes of the previous video number 5 there, about the accounting process and the closing. I'm not going to go over it again. When you get to the end of the accounting period, you're going to look and say, okay, I have 32,000 in my ledger account. I have 32,000 in my subsidiary ledger account. So I don't have any mistakes there. But we don't know, that 32,000 isn't an accurate figure because some of that is bad debt. And I'm actually going to use the numbers in the book this time in order to keep things simple, since I'm using the exhibits from the book. So in our allowance account, we had a balance of $450. Now, we go through and we can see what's current, what's due in 1 to 30 days, due past due in 31 to 60, 61 to 90, so on and so forth. And notice that we have those same time frames right here. And we notice that our balances here are the same balances that we have here. Okay, so we've just listed them, slightly different. But here's the thing, from our historical records, and again, this is like going back and figuring out for our business. Okay, if you're a brand new business, you would kind of use industry standards. But after a period of time, you're going to want to figure out your own percentages that apply specifically to your business. So what has been determined is that anything that's current, 2% of it's going to be bad debt. Anything that's 1 to 30 days, right, is going to be 5% of it is going to be bad debt. Anything that gets to 31 to 60 days, 20% of it is going to be bad. Okay, 61 to 90, 40, and so on and so forth. So we know what these percentages are, for these time frames. And again, that's our historical record. So that's our best estimate. And you have to keep track of that from accounting period to accounting period or year to year. I mean, if your accounting period is, let's just say it's a month long, okay? You don't need to do that at the end of every accounting period, especially if your business is kind of, stable and it doesn't vary that much. But so I would find these percentages, and I would use these percentages, say, throughout the year. But then when I hit December, as part of the year end, I would go back and revisit these percentages to see if they fluctuated in any shape or form. If they did, I'd use the new percentages for the next year. Okay. So you don't need to do it every single accounting period, but if you were a stickler, but really that's inefficient and a waste of time, unless your business really does vary a lot. You would go back and in order to get the most accurate number. But remember, we're talking about estimates here, so close is good enough as long as they're within statistical norms. Okay, so you determine these percentages for these time frames. And then of course, you look and say, okay, well, what balance is in that time frame? And I multiply it by that percentage, and that gives me the amount that I'm going to write off. And when I've looked at my entire aging report and did all of that math, I add up all of those estimates, and it comes out to $1,767. Okay, that's what I estimate based upon the aging method. How much of my 32,000, right, that I estimate will be uncollectible, right? Now, here's the thing. It's $1,767. I have to look at my allowance account, and remember, I have 32,000 here as my accounts receivable. I want the balance in my allowance account to be $1,767 to be able to match that 32,000, right? So when I go to make the adjusting journal entry, yeah, I'm going to debit my bad debt expense account, and yes, I'm going to credit my allowance for doubtful or uncollectible account, right? I'm going to use those general ledger accounts, but the amount that I'm going to use is not going to be this $1,767. I'm estimating that that is the amount that's going to be bad debt based out of this entire 32,000. But I already have $450 in the account. So I want the balance to be 1,767. So the difference between those two numbers, all right, which is $1,317, that's going to be the amount that I'm going to use as part of my adjusting journal entry so that I write it off to bad debt. So I'm not writing off the full 1767. I'm writing off only 1317. Again, the difference between this and that account, this amount and that amount, 1767 less 450 gives me 1317. That's going to be the amount that I'm going to use for the journal entry in order to make sure that my estimate of 1767 is in line with my accounts receivable of 3200. I'm in 32,000. Boy, today I get these thousands and hundreds all mixed up. Such is life. All right, so that's that's the entry. This is going to be the entry I'm going to make in order to bring my books into balance. Okay, so that on the balance sheet, I'm looking at my accounts receivable has 32,000 less my allowance account, which has the 1767, and then that would give me my net accounts receivable, whatever that amount is. The difference between those two would be that amount. I'm not going to do the math, but that's what my balance sheet would look like right here. So that when I'm looking at, excuse me, anyone who looks at it says, okay, yeah, they have 32,000 on their books. They know that 1767 is bad debt, and this is my, what my actual accounts receivable should be. Okay, so you've made that adjusting entry, and then again, you've created your financial statements, and now you have to make your closing entries. So you're going to write off this 1,317. So your bad debt expense is 0, and you're ready to start the new accounting period. Okay, you come to the next accounting period, and your accounts receivable is going to be different. Maybe your accounts receivable increased, let's say, $8,000. So now your accounts receivable is 40,000. Well, your aging, right? Your subsidiary ledger should still have 40,000 in it, and you'll create a new aging report, and whatever these new balances are, right? You'll use that as part of your calculation, right? And you'll use the same percentages, or you'll look back and see if the percentages changed to make sure that you're using the accurate ones. But for the most part, they generally, after some period of time, they stay kind of stable, and you end up using the same ones. So you figure out the new balances, right? New estimates of what is going to be bad debt for those periods of time, and that's going to give you, let's just make this $2,000. Okay, so you're going to estimate that based upon the 40,000 here, 2,000 is bad debt. Okay, now you have to make your journal entry right here, right? Okay, and you have a balance in your allowance account for 1767, right? You want that balance to be 2,000, so you take the difference between the two. 2,000 less 1767, it's $233, right? So your journal entry is going to be for $233, right? Because remember, you want the balance in your allowance to match, be in line with whatever your accounts receivable is, all right? And so when I make that journal entry, now I have a new bad debt of $233, right? And my allowance is now up to 2,000. Now realize that just like if you were watching the previous video for the percent of sales method, notice that the balance here, let me erase this line here. Okay, let me get rid of this, and I can get rid of all of that. Notice that the allowance account, as you're looking at it, is increasing, and it keeps on increasing, and it keeps on increasing. I mean, it started out at 450, and then it increased to 1767. Okay, and then it's now at 2,000 because my accounts receivable went up. If my accounts receivable went down, well then yes, that balance would go down. But realize that as part of this 40,000, we still have, we've determined $2,000 of it is bad debt, right? $2,000 of it is bad debt. So our net realizable value is 38,000. Our accounts receivable account shows, there's 40,000, and some of this, like for example, let's just say this K Wilson for $950. We've determined that that's actually going to be bad debt. I mean, we're never going to get that money back. We don't want to keep those amounts on our books. Okay. Generally, if an account is 1 year old and you haven't been able to collect it, it should be written off. I mean, there are some exceptions, but the vast majority of the time, a very high percentage of the time, anything that's been sitting on your books for a year is a bad debt, and you should get rid of it, take it off of your accounts receivable. So if you've determined that this K Wilson, has this $950 should be written off, well, then you have to make the journal entry to take it off of your accounts receivable. So you're going to credit your accounts receivable for $950, and you're going to debit your allowance account, allowance for bad debt, for the $950. Okay, when you do that, all right, notice that the $950 is a credit, so now your new balance of your receivable is $39,050. Is 39,000. Oh, it should be blue, green. $39,050 is a debit, and you had $950 as a debit on your allowance, so now your allowance account actually has a balance of $1,050. Okay, it doesn't go against bad debt expense. You're hitting bad debt expense when you make the adjusting entry, when you actually calculate the balance, for your estimate, right? But when a customer is not going to pay you, you don't use the bad debt expense account. That's using the direct write-off method. Instead, what we're doing is we're reducing our accounts receivable, and the offsetting side of that journal entry, right? Here's our accounts receivable, and the offsetting side of that journal entry is the allowance account, and this helps keep that balance down. Okay, it doesn't constantly go up and up and up and up and up. All right, it so it helps keep everything in line so that the numbers don't become so inflated and unmanageable. Okay, because if it's not an accounts receivable, it shouldn't be on there. And what did we do? We reduced our accounts receivable so that when we go to do our new calculation, that amount is no longer in there, and that helps keep our allowance balance down. Okay, so just as a quick recap, if you use the aging method, the balance in your allowance account is always going to be a direct reflection of your accounts receivable, and it will go up and down based upon the accounts receivable. But if you keep the accounts on your books, even though they're bad debt, your accounts receivable will always creep up and up and up. And if your accounts receivable creeps up and up and up, then your allowance account is going to creep up and up and up, right? So you can't just keep them on your books. You have to write off those accounts receivable, and that's what helps keep the balances in line. The allowance balance will come down, your accounts receivable comes down, and things aren't overinflated on your books. All right. If you don't do that, and an auditor comes in and he sees that you have a ton of accounts in the greater than 6-month category, right? And he can see that based upon the dating of those accounts receivable, those invoices, he's going to sit there and go, okay, write them all off in order to be able to reduce it. And what you're doing is I mean, it's not going to affect your profit or loss because you already wrote off to the bad debt expense. But what it'll do is it will bring your your balance sheet more in line so that it doesn't skew your financial ratios. All right. Recall what's your quick ratio and your asset test ratio include? Your accounts receivable. Well, if your net receivable is, is $10,000 more than it should be, obviously it's going to skew those ratios, and so that you're not providing the correct financial information for third parties to be able to make financial judgments on your books. All right, so you'll have, you need to constantly be writing those things off. Okay, so I hope that made sense. If not, go back and watch the previous videos. Everything one ties into another. I had said I try to keep them short, but these two had the last one and this one here, the percentage of sales method and this aging method, has to be a little bit longer because of the calculations and going forward, rolling from one period to the next to the next. It's not just a simple matter of, here I did the math to find out this number and let me just plug it in. No, you have to take into consideration, especially for this aging method, the difference between what you actually have in the allowance account and what you calculate it should be based upon your accounts receivable. So go back and watch, all of the previous videos that have to deal with this, starting with the direct write-off method, then the allowance method, the percentage of sales method, and this aging method. And by watching them all in conjunction, you'll have a better understanding of how to record your accounts receivable accurately on your books. And if you still don't get it, feel free to telephone and speak with an instructor. Okay. So really, these videos were the heart of this chapter. But we'll pick up in the next video talking about our notes receivable.